Today in this video, we will talk about some stock market basics and we will also discuss 5 golden rules of stock investing. But before we go into those details, let me tell you a small story about myself. I started investing in stocks in 2008. At that time, I was only trading in stocks. I was buying stocks and selling it. I didn't have this realization that what actually I am doing is not investing, it is trading. Why trading? Because I am buying on from one hand and selling the stocks on the other. I was not accumulating anything. I was not holding any stocks in my portfolio. It was trading, and as per my psychology goes, I didn't like this process of trading of stocks. What I wanted actually was I wanted to buy some stocks, hold it, and see it grow over time. But I was not doing it, I was only trading. But fortunately, in those times, I was also reading a book called Rich Dad, Poor Dad. In that book, I learned two very important lessons of my life. First of all, it taught me the necessity of asset building, and it also taught me that the ultimate financial goal for a person should be to achieve financial independence. So these two concepts of asset building and financial independence ultimately pointed me towards the need of building a strong investment portfolio. And while I was researching about the investment portfolio, I realized that my inherent liking for stocks. So I started learning more about stock investing. And while I was doing it, fortunately, I came to know about the legendary investor Warren Buffett and his investing style, that is value investing. So while I was reading more about value investing, it again gave a new direction to my investment philosophy. It taught me that if we are investing in stocks, it is needless to see only at the stock price. What is more important is to look at the underlying business behind that stock. Soon I realized that looking at underlying business sounds so easy, but what actually needs to be done to do it was to learn to read and interpret the financial reports of the company. Being an engineer myself, I had no knowledge of how to read the financial reports. So I started learning about it. I started to learn how to read and interpret the profit and loss accounts, the balance sheets, and the cash flow reports of the company. For the first few months, I thought that I'm banging my head on something that I cannot grasp. But slowly, I realized that it is not so difficult to learn, but the only thing is I have to go slow. So I went slow. Within few months, I could read the reports and I could also interpret and correlate the numbers between the reports. This new ability of mine to read the financial reports opened a new avenue for me. I could now think and calculate and estimate the intrinsic value of the stocks. As my stock analysis skill developed, as I was able to estimate the intrinsic value, I could feel that my stock picking skills improved. The more I was practicing the intrinsic value estimation, the more stronger stocks I was picking in my portfolio. I could feel that with every passing month, my stock portfolio is becoming stronger and stronger. So while I was learning all of this, 5 golden rules I have noticed. And why I call this golden rules? Because I think that any man can implement these golden rules and build a successful investment portfolio, even if they do not have a very deep stock analysis skills, but just following these 5 rules can help them build a very strong investment portfolio. So in this video, let me tell you about those 5 golden rules. But talking about those golden rules, what is the need? Why we need to learn about those golden rules? Because we may not realize this, but the stock investing is a very difficult thing to execute. Why difficult? Because let's take example of our Bombay Stock Exchange. In the Bombay Stock Exchange, there are about 5,000 stocks. And out of these 5,000 stocks, majority are companies which have a weak fundamentals. Only few stocks among this plethora of 5,000 stocks are worth investing in. Now, within these fundamentally strong stocks, we must also realize that most of these strong stocks trade at a very exorbitant price levels. They are almost overvalued all the time. So to identify the undervalued stocks within this group of strong stocks is a skill that is not so easy to learn. This is where that necessity of reading the annual reports, the financial numbers of a company arise. And we will realize that not many of us have that skill of reading and interpreting the financial reports. So this makes the whole process of stock investing complicated. On one hand, we have so many stocks, but the stocks that we can really pick among those 5,000 stocks are a very handful number. And to identify those handful stocks, it's not easy. This is what makes stock investing complicated. Now, here comes the need of those 5 golden rules. If we can follow these golden rules, it not only makes the process of stock investing easy, but it also eases the implementation of stock investing for a retail investor. So, the golden rule number one: do the opposite of what the market is doing. There are three phases in any market. Either the market is bullish, or the market is bearish, or it is going flat. So as per this rule, if the market is bullish, what does it mean? The stock prices of the indices and the individual stocks are only going up. At that time, what you should do? Preferably, don't buy stocks when the market is in a bull run. At that time, if you have an option, sell your stocks, but at least don't buy during the bullish market. So when you should buy the stock? Buy the stock when the market is bearish. When everybody is selling the stock, you are buying the stock. So you are doing the opposite. In the bull market, everybody is buying, you are selling. And in the bearish market, when everybody is selling, you are buying. So this is what I called doing the opposite of what the market is doing. But you will also realize that most of the time, the market is not in a bearish or a bullish mode. It is in normal times, the stock indices you will see is either going flat or it has a very small volatility. So what we should do in those times? In those times, the necessity of stock analysis skills becomes more important. In those times, what we have to do, we have to identify a strong stock which is trading at an undervalued price. So it's tougher to invest in stocks when the market is in a normal time. The judgment that you should take that which stock to pick in normal times is not so easy. But in bearish time, we have to go for blue chip stocks. It's easy. In the bullish phase, you know that I don't have to buy any stock at this time, and if at all I have to trade, I have to sell my holdings, those holdings which looks overvalued. But in normal times, the stock analysis skill has to be there to invest. The rule number 2 of stock investing is buy good stocks and hold it for a long time. And when I say long time, it does not mean 3 years or 5 years. I know a lot of people will tell you that buying a stock and holding it for 5 years is a long-term holding approach. But for me, it's not interesting. If I go ahead and buy a stock like TCS, Britannia, Hindustan Unilever, or few banking names like HDFC, ICICI, SBI, these are very premium stocks. It's not so easy to buy these stocks at a good price. But if I have bought these kind of stocks at a good price, I don't want to sell them in next 3 or 5 years. I want to continue to hold it forever. Yeah, forever sounds a little bit vague. So I will give it a number that let's hold them for 20 years at least. So when I'm buying a good stock, and it takes me some time to identify those stocks and to buy those stocks, when I have them in my portfolio, I will rather continue holding it for next 20 years. The third rule of stock investing is diversification. It's complicated to implement. For a retail investor, it's not so easy to implement, but I will give you an idea how to do it. Suppose today you got an opportunity to buy a stock and you have invested 10,000 rupees in that stock. How you should diversify now? So what you should do, if you have invested 10,000 rupees, 50% of 10,000 rupees, that is 5,000 rupees, put it in the FD. Buy stock on one hand and buy a FD on the other hand. If you are using 10,000 rupees for stock investing, at least put 5,000 rupees in the FD. So this becomes a diversified portfolio now. So on one hand, you have a 10,000 rupee worth of stock, and on the other hand, you have a debt instrument of 5,000 rupees. So this way your portfolio becomes diversified. Your portfolio now has a 66% holding in equity and almost 34% in debt. So this gives a balanced portfolio. This is a very easy rule to build a diversified portfolio. A more professional approach will be to spread your money among equity, debt, gold, and real estate. It's very easy these days to buy these instruments from the comfort of your home. If you want to buy a debt instrument, buy a debt mutual fund using your trading app. You can also buy a gold ETF or index fund online. In the past, investing in real estate was not so easy because we had only one option to buy a physical real estate property. But now we have an option in terms of REITs. We can buy REITs online like shares and allocate our money in the real estate sector. So diversification becomes easy. But if it is so difficult for you to buy gold and real estate and debt, you do not have so much bandwidth to spread and think about all these investment options, follow that rule. Buy a stock and invest 50% of your equity money in buying a fixed deposit. This will build a reasonable diversified portfolio. The fourth important rule of stock investing is to expect realistic return. When I entered the stock market, I entered with a concept that in stock market, if things go well, I can double my money in few months. This is a wrong concept. Stock market is not for making quick money. Stock market gives you an opportunity to multiply your money fast, but there are two conditions. That money that you have invested must be held on to for a very long time, and number two, you must be very careful where you are putting your money. You cannot invest money in buying stocks of a weak company and expect that your money will double. No, it will not happen. In fact, your capital will erode. You will face losses. So just to give you an idea of what kind of realistic returns you can expect from the stock market. Suppose you are investing when the market is bearish. There is a crash, there is a major correction. If you are investing when the index is already at the bottom, in that range if you invest, you can expect a 20-25% return per annum if you hold these stocks for next 15-20 years. If you are investing in small corrections time, when the index has corrected by 5, 6, 8%, during this time if you are investing, the rule should be you should add to your existing stock portfolio. Means if your stock portfolio has stock A, B, C, then during these corrections, these small corrections, what you should do, you should add on to the holdings of these ABC companies. Don't buy new stocks. During corrections, buy more of your existing stocks. And when you do that, you can see that in a long term, the stocks that you have bought during these times can fetch you a return of around 12 to 15%. Now the trick is what we should do in the normal times. In normal times, first of all, the effort is more. You have to apply a lot of stock analysis skills to identify those stocks that is worth investing in those moments of time. So buying stocks during times when the market is normal, it is going flat, holding those stocks in long term can give you a return of 8 to 12% easily. So when we say realistic returns from stock market, it can range from 10 to 12% to 25%, but don't expect more than that. Even if you are earning a return in tune of 20% or something, it's fantastic returns. The fifth and the final rule is sell stocks of weak companies. Now during all this video you have seen that I'm always talking about buying your stock and holding it forever, holding it for next 20 years. But in this point, it is also necessary that we should sell the stocks at a right time. Now, important is to realize that which stocks to sell. I'm not telling you to buy a good stock, buy a very fundamentally stock and sell it. No, don't do that. But if you have some weak stocks in your portfolio, and as you realize that you have bought a weak stock, it is better to sell it. Even if it is coming at a loss, sell it. Don't hold those stocks. No matter how carefully we are picking our stocks, some weak stocks will enter your portfolio. Initially, you may not realize that you have picked a wrong stock, but as soon as you have realized, don't delay, sell that stock the next day. Because what happens with weak stocks that once it goes into the cycle of price fall, there is no bottom for those stocks. So these are the 5 golden rules that you have seen. Why these are called golden rules? Because even we retail investors can use these 5 rules to build a strong investment portfolio like a pro. Maybe we do not have those very strong inherent skills of stock analysis, but if we can follow these 5 golden rules, we can build a very strong investment portfolio. And always remember that when we are building an investment portfolio, we are doing it to attain financial independence in time to come. To attain financial independence, you have to buy good stocks, buy at a right price, and hold them for a very long time. Please do subscribe to my channel. Thank you very much for watching.